Hey guys, it's Arlie from Arlie's Financial Journey. I'm here today to talk with you guys about my top 3 dividend stocks for 2021. So let's get right into it. All right, well, the first question is, why invest in dividend stocks? Well, they're safer in a down, choppy market. Like we're experiencing right now when the market's up and down, moving a lot. These dividend stocks tend to be more right down the middle, small up, small down. If the stock stays neutral for the year, you still make a profit. If you're in a normal stock and it goes up 1-2%, it's a pretty tiny profit. If you have a dividend, that makes it a much more palatable investment. You don't have to sell the stock to realize profits. This gives you a tax savings. Instead of having to sell if you're up 5-10%, you just keep collecting that dividend, and that becomes your profit while you hold the stock. If the share price goes lower, for most stocks, oh no, this is bad, I've lost value. For dividends, well, now you can buy more shares for a cheaper price and get the same dividend. So long term, when the stock goes down, it's not a bad thing for these dividend stocks. And finally, especially if you're younger, you can reinvest your dividends and it'll grow even faster. Now, traditional dividend stocks are usually companies like Walmart, Coca-Cola, Visa. As you can see, these tend to be what they call safer areas, retail, financial, consumable goods. They call it the value sector. But you're looking at dividends between 0.62 for Visa, 1.66 for Walmart, a little over 3 for Coke. So they're nice dividends, but they're not enough to really make a big difference. Overall, they still have some risk though. As you can see, Walmart's down 7%, Coke's down 5%, Visa's down 4%. So you have some upside with a lot of these. They can go up and down, but also some downside. And with the dividend being only, 0.5% to 3%, you're not really getting enough bang for your buck. It takes a lot of money to put into these guys to really make a long-term investment in dividends. So in some ways they're useless. A growth stock at least pays you with that growth. These value stocks are almost like money holders to slightly beat inflation. And really, when you're investing, that's not what you're trying to do. So let's look at some better dividend stocks. The first one on my list is a company called Main Street Capital Corporation. So stock symbol is MAIN if you want to look it up. So Main Street, they're what's called a BDC, a business development company. So what they do is they provide capital to low-risk companies for an equity stake or a higher loan yield in return. So again, think of them kind of like Shark Tank for small proven businesses. They pay a really nice dividend, 6.4%, that you get paid monthly. So that'll compound a little bit faster than your quarterly ones. And it's up 19% already in 2021, despite COVID and everything else. A lot of these stocks were beaten down a bit in 2020, so it's a good time to get into them right now before they keep going up. The next one is called Altria, stock symbol MO. So this is kind of an interesting company. They're more involved with a cross section of industries. They've got tobacco, they got cannabis, they've got beer and wine, they own part of Anbev, Anheuser-Busch, and they also do the e-cigarettes and vape stuff. As I said, they have their hand in numerous industries, so really their risk is diversified. If one or two of these takes a hit, they have others that'll cover for it. They pay a 6.5% annual dividend, again, paid quarterly. That's a nice dividend. And so far they're up 21%. Another stock that was kind of beaten up a little bit during COVID, if you get in now, this one could really pay off by the end of the year. The last one is one called Starwood Property Trust. So Starwood is what's called a REIT. It's a real estate investment trust, and they do mostly commercial mortgages. Again, back to COVID, they survived. It's hard for a lot of the real estate trusts, but they made it through. In part because they have such a good eye for these high-value commercial properties and finding even some residential apartments and different commercial buildings and kind of repurposing them. They've really done a good job in the last 6 to 8 months of kind of rebranding themselves and getting back in the profit area. They have a really high dividend, 7.7% paid quarterly, and so far they're up over 27% this year. So as you can see, these 3 stocks, not only are they up and provide some upside, I would say more, to expect the kind of 15 to 20% for the year. So the fact that these guys have been so beaten up, you might get a little bit more this year than normal. But the reason to get in is for these dividends. So now let's look at it, right? We've got my 3 versus the traditional kind of old guard 3 dividend properties. So let's say we invest $5,000 in each stock. Again, with the ones I displayed, they have a higher upside for the stock price. I mean, some of them are already up 20%. Lower risk. Again, we've had a pretty big pullback here the last few months, and these guys haven't been hit that hard. And look at the dividend that's generated by each of these. So we're talking about $15,000 in each of these. So on my side, you get over $1,000 a year of dividends. On the traditional side, you're about $270. So overall, high dividend investments are much better than the low dividend traditional investments, because not only do you get the same upside, if not more, you can really start generating some cash flow. So if you generate $1,000 of annual dividends for $15,000 and you keep it in there for 5-6 years, you're going to be getting 30-40% profit without even selling the stock, just from these dividends. So if you're looking for something that's a little bit safer than growth and has a little bit more upside than traditional value, bank, cruise lines, airlines, I'd recommend checking out these 3 stocks. Again, it's Maine, Altria MO, and then Starwood STWD. So I'll talk to you guys on the other side. Thanks for watching.